Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Spectrum Brands Holdings, Inc. annual report. Spectrum Brands Holdings, Inc. offers a diverse range of businesses and services across various segments. The company's home and personal care segment provides home appliances under several brands, including Black & Decker, Russell Hobbs, and George Foreman. It also offers personal care products under the Remington brand. The global pet care segment is another significant business area for Spectrum Brands Holdings, Inc. This segment caters to pet owners with a wide range of products, including rawhide chews, dog and cat food, grooming products, and aquarium kits. The company's brands in this segment include Good & Fun, DreamBone, IAMS, EUKNUBA, Nature's Miracle, FUR Reminator, and Tetra. In addition to these segments, the Home and Garden segment offers outdoor insect and weed control solutions under the Spectracide brand. It also provides household pest control solutions under Hot Shot and Black Flag brands, as well as personal use pesticides and insect repellent products under Cutter and Repel brands. The company's Rejuvenate brand offers household surface cleaning, maintenance, and restoration products. Overall, Spectrum Brands Holdings, Inc. operates through three segments: home and personal care, global pet care, and home and garden. Its diverse range of businesses and services caters to various needs of consumers across North America, Europe, the Middle East, Africa, Latin America, and Asia-Pacific regions. Spectrum Brands Holdings, Inc. has experienced a significant decline in its stock price over the past year, dropping by over 22%. This downturn can be attributed to several key factors. The company's disappointing financial results for fiscal year 2025 were a major contributor to this decline. Spectrum Brands reported a 5.2% decrease in net sales and a 22.2% decline in adjusted EBITDA compared to the previous year. The Q4 2025 revenue miss, where the company fell short of market expectations, further exacerbated the situation. Supply chain issues and category softness also played a significant role in the decline. The global pet care and home and personal care segments experienced top-line decreases due to supply constraints and general softness in these product categories. Additionally, cautious consumer spending and increased competition from private label brands negatively impacted Spectrum Brands sales and profit margins. The company's organic sales had been consistently falling over 8 consecutive quarters, averaging a 1.8% year-on-year decline. This bearish outlook among investors regarding future revenue growth and profitability has led to the current stock price of $64.53, significantly down from its 52-week high of $87.23. The company's forecast for fiscal year 2026, anticipating flat to low single-digit growth in net sales and EBITDA, further reflects the ongoing challenges it faces. Spectrum Brands Holdings, Inc. maintains a market capitalization of $2 billion, broadly in line with the industry peer group. Spectrum Brands Holdings, Inc. trades at a lower price-to-earnings ratio of 17 times and a lower price-to-book ratio of 0.8 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company maintains a moderate leverage profile, with liabilities making up 43% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has increased on average, but the growth is not consistent year over year. This may indicate one-off events such as asset sales or capital raises, rather than durable business performance. The company has aggressively reduced its share count by more than 5%, indicating a strong shareholder-focused capital allocation approach. The company have a dividend yield of 2.91%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. Net income from continuing operations saw a significant increase of $100.2 million in fiscal 2025. This growth can be attributed to various factors that contributed to improved profitability. One key factor was the implementation of tariff-related pricing adjustments, which allowed the company to pass on increased costs to customers. Additionally, effective cost management and a decrease in total selling, general and administrative expenses also played a crucial role in boosting net income. These efforts not only helped reduce operational costs but also enhanced the company's overall efficiency. As a result, the company was able to maintain its competitive edge while maintaining profitability. The improvement in profit margins can be seen as an indirect consequence of these strategic decisions. By managing costs and adjusting pricing, the company was able to increase its revenue without compromising on profitability. This approach not only helped the company navigate challenging market conditions, but also positioned it for future growth. The financial performance of the company is a crucial indicator of its overall health and sustainability. A key metric to assess this is operating cash flow, which measures the amount of money generated by a company's core operations. According to the provided information, the company has indeed generated positive operating cash flow from continuing operations, with a figure of $204.1 million. This indicates that the company's core business activities are generating sufficient funds to cover its operational expenses and investments. Furthermore, when considering adjusted free cash flow, which takes into account non-cash items such as depreciation and amortization, the company still manages to generate a substantial amount of $170.7 million. This suggests that the company has a strong ability to convert its earnings into actual cash, which is essential for investing in growth initiatives, paying dividends, or repurchasing shares. Overall, these figures demonstrate that the company is generating positive operating cash flow, indicating a healthy financial position and a solid foundation for future growth and success. Management is emphasizing a multifaceted approach to drive the company's future success. The primary focus will be on organic growth, which involves investing in existing business areas to stimulate expansion. Additionally, the company plans to pursue strategic acquisitions that align with its long-term goals. The management has also identified key priorities that will guide their decision-making process. These include product and content safety, environmental sustainability, human rights and ethical sourcing, and employee development. To achieve these objectives, a comprehensive blueprint has been developed to reduce the company's environmental footprint. Furthermore, the company's strategy is centered on long-term growth through a combination of organic expansion, brand strengthening, capital return to shareholders, and disciplined mergers and acquisitions activity. This approach aims to create sustainable value for stakeholders while minimizing risks. The company's financial performance is influenced by its strategic business decisions, including acquisitions and divestitures. Acquisitions involve the purchase of other companies to expand operations or increase market share. In this context, specific metrics are included in calculations from the date of acquisition, such as adjusted EBITDA, adjusted average inventory turns, net sales, adjusted free cash flow, and adjusted return on average equity. On the other hand, divestitures refer to the sale of company assets or subsidiaries. When calculating financial performance, certain metrics are excluded from calculations related to divested businesses. These include adjusted EBITDA, adjusted average inventory turns, net sales, excluding amounts resulting from dispositions, and adjusted return on average equity. By excluding these metrics, the company can accurately reflect its current financial position and performance. The company's financial activities have been notable in recent times. One of the key highlights is its dividend payout, where it has distributed a significant amount to its shareholders. This demonstrates the company's commitment to rewarding its investors and sharing its profits with them. In addition to paying dividends, the company has also engaged in share buybacks. This strategic move aims to boost shareholder value by reducing the number of outstanding shares on the market. The substantial sum allocated for this purpose indicates a strong focus on maximizing returns for its investors. That concludes the financial summary for Spectrum Brands Holdings, Inc. Feel free to comment below, and I will be happy to answer them when possible.